Welcome back. Motilal Oswal is bullish on Prestige Estates, and they are expecting calendar year 2023 to be a defining year for the real estate company. That's Prestige. They have 6,500 crore rupees of inventory in ongoing projects, and Motilal Oswal has raised their FY24 pre-sales growth estimates by 16%. To discuss whether this is plausible and what is the launch pipeline and booking trends looking like, we are joined by Irfan Razak, Chairman and Managing Director, Prestige Group. Okay, Mr. Razak, good morning and Happy New Year to you. Well, if you can tell us, what are the trends in bookings? Are they much better than what you saw in 2022?
Good morning, Lata, and Happy New Year to the entire team and the viewers. Yes, actually, we have a very strong launch pipeline, like you said, and that is what is making us also very confident. Yes, we've entered into the final quarter of this financial year. We already have, the first 2 quarters did 6,500 crores of bookings, and our target is, and which will remain the way it is, at around 12,000 crores for the year, which is 2,000 crores plus from the previous year, and maybe we can just beat that. Now, what we are now struggling for is that we have lack of inventory, especially Bangalore. The inventory is less, and that's the reason why we are working hard to see if we get all our approvals and our RERA numbers in place so that the final quarter should be the best quarter that we've ever had. The teams are working hard and the demand is always there. And I believe that now we have inventory coming in from Bangalore. We've got large projects coming in Hyderabad. We already have large projects now in Mumbai. And the smaller cities like Kochi, Calicut also will contribute. Now, with all this put together, I believe that 22-23 will be a defining year. As rightly predicted, and the sales momentum is continuing. On the other hand, apart from the sales, our teams are working very hard for delivery. We have delivered substantial inventory this year, and then the teams work really hard to see that the delivery pipeline is on happening. So that combination is what is giving confidence to customers to keep committing and buying their home.
Okay. Mr. Razak, morning. So you said 12,000 crores for the full year. FY23 is what you're looking at in terms of bookings, and you've done 6,500 crores. So these are numbers that we know, but what we don't know is what FY24 could look like. And Motilal Oswal, in fact, in their note, has spoken about 15 to 17,000 crores of targeted pre-sales in FY24. Is that a reasonable assumption?
15,000 is a very, very reasonable assumption, considering that we have a lot of stock coming in the pipeline, and considering the market, and considering also that there is there is confidence in the company that we will deliver. So the teams are all there; they all geared up, and the inventory is coming in, and just now we see visibility of all the approvals falling in place in Bangalore as well as in Hyderabad. I think 15K for 23-24, though it's a little early, I think it's pretty easy, unless something really drastic happens. But looking at things now, it should happen. We should be able to do it with ease.
10 to 12,000, 12,000 to 15,000. I think, the 12,000 target itself could be overshot just going by what you have done so far. But let's see whether or not that does happen. Now, Mr. Razak, you're sounding optimistic on sales. But what about on the capex front? I think for this year, it's in that vicinity of around 1,500 to around 2,000 crores. Motilal Oswal, they're saying that the capex could scale up to around 3,500 crores odd. Is that a rough number that we should work with?
See, now, capex, yes. Now, when we talk about capex, what are we talking about? We're talking about shopping centers, we're talking about hotels, we're talking about office. Now, this combination, we have to spend capex, and this has to come from internal accruals. And I believe that it has to have a balance of 40% debt, 60% internal accruals. So that's the balance that we like to see, not get into too much of leverage. Now, there is an option for us in the office front. That we would like to do a mix and match and see that we also liquidate a certain part of the office in prime areas so that we get some huge amount of revenue from there. So that's in work in progress, and that's why I'm very, very confident on this number of, apart from the housing sales, even the office will add up to that number. And of course, the shopping centers, yes, we will build, we will own, and we'll operate. Currently, we've just on the 1st of December, we opened the doors for the first large mall after the Blackstone transaction. And that really got us real good footfalls. 100,000 people on a weekend is unheard of, and that's the Prestige Falcon City on Kanakpura Road. And that mall is trading very nicely, though even another 40% of the trading has to start. The mall is fully leased. It's just the fit-outs that the tenants are doing. That will happen. So while that is happening, we also have the hospitality sector, the 3 hotels that which we are holding just now, the large ones, all trading very well. And that's the Conrad and the JW Marriott and Prestige Gulfshire, as well as the Sheraton Grand and Whitefield. These are the 3 large assets. These are trading well. There are many assets in the pipeline, many malls in the pipeline. It will add to the capex spend, but the balance should be between a 40% debt and a 60% equity.
What are rentals doing? What's the expectation as you end FY23? That's 22-23.
If we talk about office rentals, the good news is the demand has come back. The other good news that we are waiting to hear is that people should start working from office. And now with this sort of news that COVID, no COVID sort of situation, but I believe now there is a push from all the companies that everybody should come back to office and start working from office. The demand for office is back. The inventory is very minimal. The vacancies are very minimal. And of course, the rentals have firmed up. So saying that, and this year, till December quarter, we've closed quite a substantial amount of leasing. And this is going to continue. I think whatever we build, the demand is going to be there. The vacancy level as of now on the inventory that we have is pretty low, around 3% to 5%, not more than that. So I think things are very positive. Things are looking good, and they will continue to look good. In fact, there'll be a lot more demand that will come into the office sector.
So I wanted to ask you a little more about your plans in Mumbai. You know, the last time you said you're doing a lot more work in Mumbai. And we were having this chat with Ramdev Agarwal of Motilal Oswal yesterday, where he said that, you know, premium market in Mumbai is just skyrocketing now. I mean, places like Juhu and Andheri are now at 75,000 a square foot for a worthwhile project. What would the plans be from Prestige's end, say, over the next 2 to 3 years?
We have a substantial work in Mumbai. We have the Prestige City in Mulund, which is selling very well. And apart from that, we have premium projects coming up. One is the Ocean Tower in Marine Lines, and also the Nautilus, Prestige Nautilus in Worli. Now, these 2 projects we've been working on. We've committed money on this, and these should get launched. I think the Marine Lines Ocean Tower should get launched in this quarter, but the Nautilus will definitely get launched in the next financial year. Now, I don't want us to get into too aggressive a situation. We are going to launch these. We are going to make sure that these are stabilized, and then and only then are we going to look at more. There are a lot more proposals coming, redevelopment, and all of it. But we definitely would like to be a little more measured, a little more careful, and take it up one by one. There is opportunity, but while there is opportunity, we don't want to throw caution to the winds. We want to be a little measured. We want to launch these projects. We want to see how they perform. Prestige Jasdan Classic in Baikala has done well. continues to do well. Construction is on in full swing. So that's the confidence that we have. And apart from that, these are two very large developments that are happening in office. One is the Prestige. We used to call it the Liberty Towers, and that now we've rebranded it as the Prestige. And that construction is going on, but that, as far as we are concerned, we'll hold on and keep it for lease. Also BKC1.
Okay.
Yes,
Mr. Razak, we got that. Actually, out of time. Thank you very much. We know your Bombay plans are big, and all these are premium properties. We'll continue the conversation. Thank you very much indeed for joining us.
Thank you, Lata. Thank you so much.
Okay, so we now move on to another conversation from two mutual fund experts, Shailesh Rajban, the Chief Investment Officer, Equity Investments at Nippon India Mutual Fund, and Amit Tripathi, the Chief Investment Officer, Fixed Income Investments at Nippon India Mutual Fund, are joining us. Well, both from the same group, so we want to get an idea of the equity-debt balance as well as favorite themes. Gentlemen, thank you very much for joining us. Well, let me start with Amit first, rather than Shailesh. Amit, do you think that you will be in a better position this year than the equity master? Are you likely to see a preference for debt from equity this year?
Good morning. Yeah, I think the carry part of the fixed income returns has definitely improved significantly, and that does give fixed income kind of a better ground to start with for the remaining part of the year. To that extent, I would say that in terms of allocation, yes, fixed income would be a reasonably larger part of allocation this year vis-a-vis what was the case in the last 2 years.
Shailesh, would you agree? Everyone we ask believe that even if Nifty, which is expected to, Nifty outperforms global indices, especially Wall Street indices, are seen declining this year. So will debt be more attractive in terms of gains than equity?
Clearly, for the last several years, it's been only equities as an asset class which really delivered. And I think now we have seen there is certainly a shift towards higher interest rates sustaining for some period of time, making alternatives like debt also attractive. So I think clearly the world has shifted. So the role of debt has clearly gone up significantly, and I think it should also become an important asset class as we get along from here.
Okay. On the equities front, Shailesh, what is the expectation now in terms of earnings? For the full year, what are you penciling in, and what are the spaces, the sectors where you see an outperformance on the earnings front?
The earnings clearly will have some kind of a struggle versus, say, what was anticipated 6-12 months back in terms of the kind of earning growth that would come because of multiple global factors like the US side or the export demand from Europe and even what's happening in China. Clearly, there will be an earnings struggle. Earlier expectations were trending in the range of 15-16% kind of compounding of earnings over the next 2 or 3 years. I think at least in the next 12 months, we are looking at early double digit, like 10-11% kind of earnings growth, which is a meaningful step down from what would have been the normal course post the recovery from COVID, and primarily driven by the global demand challenges which are there. Even in India, we have a very strong domestic demand recovery, but now as we enter the post-COVID phase, as we call it, could there be a slowdown in terms of the pent-up demand which came about because of COVID is a factor which we would want to watch out carefully for the next 2 or 3 quarters. From a sector point of view, interestingly, many sectors are now coming back to life, and we are back to the normal world where the traditional sectors are finding greater favor and finding greater expectations of earning revival. For us, it's the investment cycle, which I think the engineering and the manufacturing space, which clearly is best positioned from an earnings point of view. And there the earnings could be maybe 30-40% higher than what even index earnings can be over the next 12-18 months or even longer. Similarly, banking earnings should beat market earnings generally over the next 12 months as well, given the sweet spot they are in, the demand for credit, the ability to price, and the kind of very low NPAs in the cycle or virtually no large credit costs in the system. Other sectors which appear interesting more on a valuation point of view are, and the recovery in growth is pharmaceuticals, and there are certain ignored sectors like insurance. So these are broader 3 or 4 categories which we think will matter in the next 12-18 months for investors to do well.
Okay. Well, then let me get back to Amit. Amit, which category of debt funds would you recommend or would you believe will do well? Would you go more for credit opportunities, considering that there are such healthy balance sheets? Would credit opportunities be the sweetener?
Yeah, you're absolutely right, Lata. Possibly the healthiest balance sheet that we have seen for some time now. The issue, although, has been in terms of pricing in the credit space, and while that is getting corrected as we speak, I guess it will be another 6 to 9 months where you get the requisite spreads across board for the incremental risk that you're taking. So for us, it is more rate focused right now, and you tend to capture spreads in selective spaces where you're getting it right now, but don't try to overdo it, because across the board, the banking system pricing is still reasonably aggressive as compared to where the capital markets would want to be in terms of credit spreads, that is. Within rates, I guess we are in that phase where one would typically want to be in the intermediate duration part of the yield curve. From a product perspective, it would typically be products which would run a duration profile of around 2 to 3 years. The reason for that is simple. The reason is that as we are closer to the terminal rate, maybe we reach there in the next quarter or so. The focus will not only be on current carry. The curve is very flat, so carry across board is the same essentially. But the focus will not only be on current carry, but the focus will also be on preserving the current carry for some period of time, because while this year might be completely about carry, as we enter into the second half of this year into next year, at that time the preservation part might play some role as rates start to inch down. And in that sense, I think intermediate duration is space to be to capture both the current carry as well as preserve it to a reasonable extent.
Okay. Shailesh, just one follow-up question. You said that, earnings growth is going to disappoint from 15-16% projected earlier. It's now 10 to 11%. Which are the sectors that could drag the earnings down? You spoke about manufacturing and banking on the upside, but on the downside, where do you see the pressure?
See, we've got several sectors which have seen a bump up. Say, for example, metals had an extraordinary growth in profits in the last couple of years. So high base there will matter. And on an absolute basis, metals are a meaningfully large component of overall profitability of the indices. Even you have consumer companies might struggle a little bit still on earnings, at least for 1 or 2 quarters till the rural growth rebounds. So that is one more space where earnings can be a little muted. I think the disappointment, or I would say the lower earning trajectory, is more a function of sectors having greater global exposures. And even IT services falls into play, where you may have maybe single digit or thereabout earning growth in the next 12 months versus what initially was running early double digits or a little higher. So these are spaces which might be challenged, and primary pressure coming from global growth and secondary pressures coming from very sharp rebound in profitability in certain sectors like metals and maybe retail and some spaces which can normalize in the next 12 months.
Okay, all right, gentlemen. Thanks so much for stopping by and filling us in with your insights. Wishing you all the best for 2023. Well, moving on then, NCC, that's the next corporate on our radar. The construction major has bagged 5 orders, aggregating to around 3,600 crores from the state government agencies for the month of December. To get an all-round check on the order book, the debt outlook and execution, more importantly, we are joined by Mr. Vijay Kumar, Head and VC Finance at NCC, who joins in. Hi, Mr. Kumar. Good morning. Thanks so much for joining in. Firstly, wishing you and your team all the best for 2023. It's ended 2022 on a good note. So good going for you. Well, I wanted an update from you on, post this big order inflow that we have seen. What's the guidance from here on? Now, earlier you were guiding for 30% revenue growth, order inflows of close to around 16,000 crores and margin improvement. Do you want to revise any of these 3 numbers upwards? Revenue, order inflow, as well as margins?
Very good morning to you, and very happy New Year to you. Yeah, I think this year we made a good beginning. This quarter, the third quarter, we have bagged a very good number of orders, which is like 5,000 crores. with this, actually, we haven't given any specific number as guidance, as management is to come out with specific numbers for this. So I'll not be able to exactly comment upon that. But however, I think this pace is expected to continue. If you see our order inflow during this year, approximately like 12,000 crores. We are still Q4 yet to go. So, and now you see the commodity prices are also getting moderated. So this means the profits are not under stress like
Right. So,
like
Mr.
it was
Kumar,
any construction.
right.
Yeah.
Right. So, Mr. Kumar, you're already at 12,000 crores of order inflow. Just
Yeah.
extrapolating and doing a rough math, you should at least do 16,000 crores of order inflow for this year. Is that a fair assumption? And also earlier, I think you all had guided for a 30% revenue growth for the year, right? Which was revised upwards. Do you want to further revise that or stick to 30%?
No, 16,000 crores could be a likely figure, but we have got only one quarter left out, and 5,000 crores of order what we have got in Q3 is the highest awards what we got come in the last 3 quarters. But however, it is a little bit optimistic, I would say still. What is your next question?
Revenue guidance, revenue growth guidance, 30%.
Revenue growth guidance, I think we have been maintaining a pace of 30-40% in the last 2-3 quarters. I guess I think we should be able to maintain the same guidance. As I said earlier, though there is no specific guidance as a number as such, but however, I think the looking to the order flows and the order execution levels also, I think the pace is expected to continue.
Last time you told us your execution levels were a good 45% higher than year-ago levels for first half. I mean, that was understandable because we were comparing with all those delta-driven quarters in 21. How is execution now? Is second half better than your previous second half or pre-COVID second halves?
Yeah, it is actually definitely, Lata. In fact, even during monsoon season also, we have posted a good growth compared to even QOQ basis or YYY basis also. In Q1, we have clocked something like 3,000 crores of execution levels, whereas in Q2, we maintained even more than 3,000 crores of execution levels. So I would see, I think the same execution levels should continue. However, it will be a little bit more because the activity will be more in the last 2 quarters, Q3 and Q4. So it will be more than that.
Okay. Will your margins also improve? Because you specifically said that material costs have gone down.
Yeah, material costs have moderated. We expect that there should be some sort of improvement in the margins, but I'll not be able. Last half year, we have posted an EBIT of 9.6%, which is slightly less than what we have posted in the previous year to that. So going forward, I think there should be some marginal increase. That's what we can hopefully expect out of that.
Okay. And these orders that you spoke about, right? 5,000 crores in Q3, is a large chunk of it coming from state government agencies itself or any other avenues from where you're getting orders? And even in terms of order visibility, what are the avenues?
You see, largely these orders came in water, irrigation, and electrical segments. We are one of the front runners in Jal Jeevan Mission. We have these orders from UP, Karnataka, and other states, Gujarat and other states like that. So going forward, I think even these segments are also going to contribute a good chunk of revenue to the top line of the company.
Have you seen any improvement in orders from state governments?
Yeah, I think our numbers reflect that. Even Q3 is much more than Q1 and Q2. We haven't seen any kind of dip in the funnel what we have in front of us.
Right. All right. Mr. Kumar, the BMC order was floated for around 5,000 crores. I think that was with regard to concretization of the Mumbai roads. And then that was cancelled. But it was expected to reopen as well. I think a couple of 100 kilometers. Have you heard anything on that front?
No, I'm not really sure about it. We have only one order from BMC with regard to that, which is sewage treatment plant in Malad. So
Okay, all right.
that is size of 4,000 crores.
All right, that's that's something that the street is waiting for as well. Besides that, what about your non-fund based limits? If you could tell us what is it, and are you looking at increasing it?
Yes, we have non-fund based limits of 11,000 crores as of now, and
Yes.
we are enhancing it by another 2,000 crores this year. So I think that will be adequate to meet our requirement for next 1 to 1.5 years.
Okay. Can you give us some guidance on your debt reduction plans? What does the debt stand at right now and any plans to bring it down? I'm not talking about the project-related debt, but overall?
See, overall debt was 1985 crores at the end of H1 2023. If you compare the same debt levels with the last year, it is already less by 220 crores, which was it was nearly 2,100 crores at the end of last H1. Okay. Now, as the working capital turnover is improving, we are seeing a good reduction in the debt. So I think that trend will continue.
Okay, we will leave it at that, Mr. Kumar. Thanks a lot for joining in and all the best for the new year. That is, by the way, the first take on Radiant Cash. It's a decent listing, actually, considering that it was, the IPO was undersubscribed. It's not a bad listing coming through. 6% higher on Radiant Cash. We'll get more details on that in a bit. For now, we'll take a quick break on Bazaar. When we come back, Mitesh Thakkar of Earning Waves will be joining in for some technical trades. Stay tuned.
Well, the call earlier today was don't go ahead and rush to buy the Nifty. And that seems to have played out. Nifty is down 130 points from the high point of the day, approaching that crucial level of 18,050 to 18,100. Mitesh Thakkar is back with us. Mitesh, what have you made of the first hour of trade and also any fresh picks?
Yeah. So I think, we have once again failed at 18,250. Today high is around 18,243. So that becomes a very now recognized kind of a pivot. But I think broadly it's still a market which is ranged between 18,000 to about 18,250. So maybe we'll head towards the lower end of the range. In that sense, I think, we've kind of cut our stock long exposure and added some short to it. And right now also I have one buy and one sell recommendation. SBI Life is something which is showing good momentum on the upside. So that remains a long side kind of a trade. Keep a stop below levels of 1255. Look for targets of 1310. While Reliance is coming under pressure, and that's where some intraday charts have turned slightly negative. So that's a sell with a hook at 2556 for targets of around 2480.
Okay, thanks a lot for that, Mitesh. We'll touch base with you again. Now let's shift to the commodity markets, and Manisha Gupta is waiting by. Manisha, I'm guessing it's going to be crude.
It is. It's crude and gas. I put all of that together because overall the energy pack has started the year on a weaker note here. The crude oil price is essentially, we're trading at a 1-month highs on the first day, that is on the 2nd of Jan. But by 3rd, we are off those 1-month highs, and we've seen 4% of a decline in the overnight markets there. But not just crude oil prices, overall crude petroleum prices also have seen a sharp decline. So the heating oil prices fell 5% overnight. The biggest decline really came in for the natural gas prices in US. That fell nearly 10%. Even the coal prices, after gaining 138% in the previous year, have now fallen below $400 per ton. Well, the natural gas has extended the major losses because, and the prices have gone now to the pre-invasion levels. The reason for the decline in the gas clearly has been many. But at this point in time, we are trading at a 10-month now lows. We did gain 22% for the natural gas prices in the previous year. But this year, the start has been on the weaker side here. And the reasons should come in on your screens now. To begin with, we are looking at prices now breaching $4 per MMBTU on the lower side. So we are into a bearish territory now. The prices have declined nearly 60% from the highs of $10 per MMBTU that the market touched in August. And not just the US gas prices, the European Union gas prices are now down 75% from a record high that we hit in the month of August, just about holding €74 megawatt hours there. The markets also have seen a decline because of the fact that you have enough inventories, more supplies coming in, but the demand clearly is not catching up. We are looking at warmer than expected temperatures in US and Europe. That has been weighing onto the markets. It also has to do with the record LNG imports that Europe has been doing and higher than normal stockpiles that we have seen overall in Germany, which is the biggest gas importer and consumer in Europe. And the overall European Union inventories are also higher. There is increased power generation from wind, so the gas utilization there as well has seen a bit of a a decline coming in. But the gas storage in Europe right now is at 83.5% of capacity. Last year was 70% on an average as well. Usually in the month of December and Jan, Europe and Germany hold 70% of their capacity, but we are looking at 85 to even 90% of inventories right now. That's weighing onto the markets there. You also are looking at pressure coming in from the fact that the US exports and production is hitting near record highs, especially for LNG. And then the macro also has continued to weigh on. The Chinese PMI data has contracted for a fifth straight month in the month of December and has seen a decline up to 49. There are warnings coming in from IMF about a tough year for growth in China and European Union and US for 2023. There have been various statements that we've seen come in also from US officials talking about a recession possibility in the first half of 2023. What would you watch out for now is the Russian statements that continue to keep coming in. OPEC and allies, the first meeting of this year also happens in the next week. That would be on radar. The US Fed meeting minutes are today, and you have the US non-farm payroll data on Friday. So it's going to be a loaded week, the rest of it.
Okay, loaded week. Lots to watch out for. By the way, the market is a bit volatile and weak as we head into these key numbers. The Nifty is down 100 points right now and has moved to the low point of trade. The Sensex is well under pressure. Vivek is joining in. He's going to talk about the AMFI semi-annual market capitalization classification of stocks and what you need to look at in that bunch. Vivek, over to you.
Well, that's right. So it's semi-annual, so this particular market capitalization classification will be valid for the first half of CY 2023. So, you know, the top 1 to 100 companies, the market cap cutoff this time around has come in at close to 48,900 crore. This for the top 100. From 101 to 250, which comprise the mid-cap space, the cutoff has been close to 16,800 crore, and the remaining would fall under the small cap category. Now, which are the stocks that are impacted and which are the stocks that have been upgraded from earlier mid-cap to now large cap? So the names are Varun Beverages, ABB India, Tata Elxsi, Bosch, Trent, as well as PI Industries. On the other hand, the stocks that have seen a one-notch downgrade in terms of classification from large cap to small cap include Muthoot Finance, Paytm, Bandhan Bank, Mphasis, Gland Pharma, and Piramal Enterprises. You know, in the mid-cap space, the stocks upgraded from small cap to mid-cap include Timken, Metro Brands, Blue Dart, Fine Organic, UCO Bank, and also an interesting name, demerged entity that is Piramal Pharma has made a fresh entry into the mid-cap categorization. On the other hand, stocks downgraded from the mid-cap to small-cap space. Some key names include Aavas Financials and ICICI Securities, and also keep in mind all of the new listings actually make their entrance into the small cap space. Now, why is this particular development important? Most of this list is mainly referred to by the active fund managers, and there could be entries, exits, weight reductions, and weight additions based on the scheme categorization. On the back of that, all of these stocks will definitely be in focus.
All right, thanks a lot for that, Vivek. Let's slip into a quick break. On the other side, our special segment, It's the Economy. We'll connect with Akshay D'Souza of Bizom, K. Ramakrishnan of Kantara, and Sachidanand Shukla, the Chief Economist at Mahindra Group, to discuss the state of rural demand.